Thanks so much. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, the state of the AI trade after a tumultuous week for tech. We trade it with the investment committee, as always. Joining me for the hour today, Steve Weiss, Jim Lebenthal, Kevin Simpson, and Josh Brown. Let's check the markets where we have another sell-off underway, especially in the NASDAQ. Take a look at that. It is now down more than 450 points. That equates to a 2% decline. The NASDAQ has had 3 1% pullbacks in the last 6. That was before today, so it's going to be 4 and 7 if it looks like this. It's the worst performance for a week since April 4th. That, of course, was the so-called Liberation Day period of time. What is this about? Are we sort of re-questioning spend, valuation, a little bit of everything?
You know, obviously, anybody involved in the market's been thinking about it a lot. What's this about? What's causing it? Is there longevity to this decline? And where I come out is that there's no one answer, but what I would guess is that you've continued to hear the narrative increase that tech's in a bubble, that valuation exceeds what's reasonable, and eventually, I'm not saying it's accurate in all parts, but eventually that narrative lands. And when you see a little bit of volatility, people come out and say, you know what, maybe there's something to it, so they run for the doors. Now, I haven't touched any of my positions except what we talked about before earnings in Alphabet. Haven't touched Meta, haven't touched Microsoft, haven't touched Amazon. I have no intention of doing so because, look, I thought they were overvalued, but compounders eventually grow into their valuation, and you can have momentary, destabilization in the uptrend in these stocks. But the question is, where does it end? I'm not worked up about it, but I am concerned.
Well, if you look at, so Microsoft is looking at 8 in a row in terms of down sessions. NVIDIA is looking at 4 in a row. Meta is looking for 6 out of 7. And of course, Palantir has been down 4 straight days for the first time since August. But if you pull the lens back a little bit further, you'll see declines from their most recent highs. Meta's down 24%, Josh, from its recent high. NVIDIA's down 15, Microsoft 11. And maybe you can put Meta, if you want, at the start of this, right? They're the ones out of the hyperscaler earnings days that traded the worst and raised the most questions, I think.
Yeah. Guys, why don't you give me a year-to-date or one-year Meta chart while I'm talking, just so I can put this into context. In my opinion, Meta represents the first sign that there actually are consequences in terms of stock price for quote-unquote overspending on AI CapEx without having a coherent strategy that investors can understand or believe in. I actually think this is a very positive development to see this name in a 24% drawdown. It's now only up 3% on the year. So in other words, if the market were to close tomorrow for 2025, and we were to say what was the biggest story in the market of 2025, we would all agree the AI build-out theme. Okay, great. And then someone would say, surely all of the companies involved heavily in this AI build-out must have had great stock performance. And the answer would be no. Meta is only up 3% on the year and participated for most of the year and then fell apart. I think when you think about a company that has been this successful incorporating AI into its business, and we know Meta is, the Reels product being a great example, utilizing AI to make that suggestion engine hum brings in more certainty on the part of advertisers and a higher yield per dollar spent. That's a great thing. But then people look at some of the other things that they're talking about doing, and 5 restructurings of the AI team in a year's time, and questions about what even is superintelligence, and can this company continue to make multi-billion-dollar acquisitions of startups just to attain talent. And they say to themselves, you know what? I have a much better sense of what Gemini is doing. I have a better understanding of what OpenAI is doing. I think I kind of get the Amazon strategy. I don't understand Meta's open source Llama strategy at all. And they hit the sell button. Again, not necessarily the death knell for Meta, not necessarily the end of the rally in AI, but I think it's really healthy. that investors are asking questions and reacting negatively when they don't believe in what the company is saying they're going to do. So I like it. And anyone saying a bubble, well, in a bubble, you don't have some of the most important companies in the theme in 24% drawdowns. So we may get to a bubble. I don't know that we've gotten there yet.
Yeah, I think most would, certainly those who have been on the network opining on that topic over the last, let's call it, 3-4 weeks have said, yeah, we may get to that point, but they don't see it yet. Even the ones who suggest this is eventually going to end badly, we're a ways off from that. Brad Gerstner, I think you could put him in the group. A Altimeter, of course, on in the last hour, says we're not in a bubble, says he has taken his positions down, all of them, including Meta, and he called what we're witnessing healthy. Kev, you own Meta, so you listen to what Josh has to say. Are we at, as I think I brought up for the last couple of days, an inflection point in the way investors are going to view these very, very large numbers of spend versus return on that? Or is this just a moment? It's just a moment that these stocks begged for a pullback of some kind, and we're just in that and don't read anything more into it than needs to be done?
I don't disagree with anything that Josh says, but I find myself in your camp, Scott. I think sometimes markets themselves can become self-fulfilling prophecies, and it's almost like you sell first and ask questions later, and I think that happened with Meta post-earnings. Now, obviously, it's continued a 24% drawdown in a really short period of time, could get you a little bit nervous. We haven't sold any. If anything, I think we'll be able to add to that position to kind of right-size it. Being up 3% on the year is pauper compared to these other high flyers within the Mag 7. So we're not buying it today, but I would look for weakness as an opportunity to add.
That's a more concise way of what I was saying. That's a self-fulfilling prophecy that the fears took hold. Mm-hmm. Everybody's saying you should be afraid, you should be afraid. Not Brad, not others that really know what they're doing. Well, not only know what they're doing. We get Sam Altman a month ago not even say that we're in a bubble.
CapEx bubble. I think he
did say CapEx bubble, but I'll tell you, I want companies, and where I sit on board of companies, you want to spend, and obviously you want responsible spending, but you don't want to miss the growth. So I'd rather have them overspend now, not saying they are, than miss what's going on. I want to be leaders.
You are spending a lot.
You are.
You're spending a lot. Amazon, $125 billion this year. Meta between 70 and 72. Alphabet between 91 and 93, and Microsoft spent $35 billion in Q1. It's going to spend more in fiscal year 26 than they did this year. UBS is out with a note, Jimmy, that talks about elevated valuations triggering the volatility and the return of it, which we've obviously seen this week, but that the fundamentals are they're justified. That the fundamentals, yes, you can say, oh my gosh, those numbers are so big, but the fundamentals justify what they're doing. Tom Lee said, too early to give up on this, buy the dip.
Yeah, I think the fundamentals support a continued rally in the AI trade and in the markets overall. In a second, I'll get to what I think is the cause of the last week or 2 weeks worth of declines, but I just want to point out—
Why don't you get to it now?
Because I want to set up why I don't think this is fundamentals. Is because 2 weeks ago, we had announcements from the top 4 hyperscalers that they're going to spend over $400 billion this year and over $500 billion next year on AI. And that money, as much as we're worried about, hey, so-and-so is taking out debt, the bulk of that is coming from operating cash flows that are growing in most cases. That, to me, is a healthy fundamental picture. But what I think is happening in the markets, and Scott, you keyed in on it when you pointed out that Microsoft is down 8 days in a row. When you get that sort of streak, it's not like on every single day people are waking up and saying, oh, valuations are high, oh, maybe this is a bubble. What's happening is liquidity is drying up, and I believe quite strongly that this is a result of the government shutdown, that 2 things are coming from the government shutdown. One, you actually are seeing aggregate demand across the economy pull back, and how can it not? Whether this is explaining Chipotle, it will be explaining the airlines that are going to have poor numbers.
You can't tell me that the NASDAQ down 5% on the week is related to the government shutdown.
If you'll let me finish, I absolutely can't.
It sounds like so absurd.
No, it's not absurd, because here's where it really comes home to roost. Hang on, Steve. Is that in all of this time, money is building up the Treasury General account at the Fed outside of the commercial banking system. It's at $1.2 trillion. That is money that should be in the commercial banking system. It should be in bank accounts, whether it's government employees or contractors. And when it's in those bank accounts, it's in the commercial banking system. It increases liquidity overall for the financial markets. Right now, we're having the opposite effect. Good news is, when the shutdown ends, that headwind becomes a tailwind. But I absolutely believe that.
NVIDIA's down 10% this week because of the shutdown?
Yeah. I find
Stop.
that, no, I wouldn't guffaw it. I would find that far more believable, and it's what I believe, than saying that all of a sudden we're not going to be spending on AI chips, given those numbers of hundreds of billions of dollars. By the way, that's leaving aside OpenAI. I mean, what I'm explaining makes far more sense to me than the idea that the fundamentals are cracking.
But it's not the fundamental. No one is suggesting. I think you're conflating a couple of things. Suggesting that people are getting uneasy with the spend doesn't mean that the fundamentals of these businesses or the story is cracking in any way. It's just you're thinking about, okay, you're pledging to spend these tens, if not hundreds of billions of dollars on the prize at the end of the rainbow. Mm-hmm. Well, I mean, okay, well, maybe you want to see the results from that before you get to the end of the rainbow, and some are questioning exactly what's being spent.
Nobody should be questioning that.
You could suggest, you could still believe in every fundamental story.
It's at earliest a 2027 result. You know, if you're looking at the things that OpenAI is building and planning to build, the results of that, whether it's for Oracle, NVIDIA, anyone else, is going to be felt in 2027, 2028. If somebody's sitting here saying, geez, I think first quarter 26 numbers should come in because maybe OpenAI isn't good for the money, I don't think that's what the market's trading on.
You know, look, here's what I'd say. It's an overly simplistic approach to say that the shutdown's driving this. It's just, I think it's overly incorrect. I think Sherlock would agree with me. It just doesn't make sense. So what I'd say is that it could be a contributing factor.
That's quite a three-piece.
Yeah. You should see the Cappy War also with that. But so I'd say that it could be a contributing factor, but that's not it. The market is, I always hate to say the market was due for a sell-off, but just the cacophony of the dialogue just hit such a loud level. That's what we're seeing. Now, in terms of the spending, yeah, you're not going to see OpenAI suffer from maybe defaults on what their plans are, but you will see in the interim cloud spending continue to increase.
Maybe you don't want to hear, with all due respect, the OpenAI people talking about and then walking back the idea of a government bailout or backstop. Like,
no,
why are you
scary.
talking about
that's
that?
Scary.
Why do you even have to talk about it?
And I don't think there's anything to backstop because there's nothing that's crossing the table yet in terms of financial.
No, but that's my point. Is like,
how far off its high?
Raising...
How far off its high would OpenAI be if it were publicly traded right now, Steve, or Jim, or whoever?
OpenAI would never have the valuation it does have right now because the due
diligence. If it were a stock, how far off its high do you think? I think 20%.
I'd say 50.
Oh, you think that bad? Okay.
Because look at their revenues versus their valuation, and that they're basically built on the credit cycle, their own credit cycle.
Yeah,
so it could be 50, maybe it's 40.
50 is a lot. The revenues, as
13
Sam
billion.
Altman,
look at the valuation.
Said on the BG2 podcast are growing so exponentially large. What's the today number is not even close to what the tomorrow number is. My only point of bringing up the commentary from first Sarah Fryer, then Walk Back, and then Sam Altman and Sachs in the administration saying there aren't going to be any bailouts. It just raises, well, why are we getting to the point where we start thinking about that? Like, why are we even talking about that? Except for the fact that you look at the tremendous amount of debt that's being raised to fund some of the spend.
It's not tremendous. It's not tremendous. My goodness, Meta took out what, 30 billion? Oracle took out 30 billion, 60 billion.
Yeah, Alphabet was 25. Alphabet was 25 billion this week. Meta was 30 billion last week. Oracle's 18 billion dollars in September. Morgan Stanley expects the big firms to spend about 3 trillion on infrastructure between now and 2028. Obviously, not all of that is coming from debt raises.
Well, you just told us 100 billion. Roughly 100 billion.
Well, that's what you just had in the last few days. Bank of America puts a piece out today, a chart that we can throw up here, as they look at, the hyperscaler spreads have widened, certainly not to alarming levels, but nonetheless, it reflects the amount of debt that's being raised to fund all this, which they suggest is a quote-unquote watch-out metric.
Definitely. Hang on a second. If you look at Oracle's debt, no, come on, he was talking to me. Just hang on a second, all right?
Relax, Jim. Just
I'm
you're
perfectly
wrong.
fine. Steve, just don't interrupt all the time. 5 to 6% is the yield on Oracle bonds. Really? That's distressed? I mean, come on, that's not distressed. And the numbers that you're totaling, $100 billion versus whether it's $1 trillion over the next 2 years or $3 trillion, the number that you sent out, that you just put out. You know, the thing is that tech investors are not used to seeing debt generally. They're not used to seeing debt.
Because they have like the biggest piles of cash this side of Berkshire Hathaway.
Which is where the other $900 billion is coming from.
That's complete nonsense.
I like when I lay a cogent thought pattern out, and he says it's complete nonsense.
It is, because Apple's been a participant in the credit markets for a long time.
Apple's not part of the AI trade.
Apple is credit. Let me tell you, if you're a credit investor, okay, if you're somebody who watches credit markets, you're not even giving a second thought. The coverage ratios on what these companies are buying from their cash flow is insane. And by the way, for the companies where I sit on the board, we want them to take on some debt. You know why? Because equity is dilutive, number one, and number two, it helps them grow. So the return that a Meta, that an Alphabet, that a Microsoft, any of them that we're getting at is monstrous.
Over an 80 basis point
it's crazy
move in spreads. It's a measure of the amazing balance sheets these companies have, the resiliency of the companies, the belief by investors in the story. Now, to a point, I mean, stocks have pulled back. These guys mentioned Oracle, which is close to now erasing all of its September gains tied to that OpenAI deal. Seema Modi's here, been listening to this whole conversation, thinking about it probably in the context of what this stock itself has done.
Stock's down another 4% today, so in fact it has erased all the gains from September. The conversation has clearly shifted from the excitement around Oracle's $300 billion deal with OpenAI, the tools it's using to build out artificial intelligence, and that record cloud backlog, to now the financing tools that Oracle increasingly needs to use to fund the build out. I can confirm that debt deal that you guys were just mentioning. It's a $38 billion debt deal that Oracle is going to the market with. Morgan Stanley says this specific deal not only reinforces the role of the credit market, but it notes that Oracle is increasingly using its credit quality to help developers obtain construction loans at a certain rate. And if you dissect the Oracle OpenAI relationship, there's over 3 gigawatts of data center capacity that are currently in the works. RBC Capital analyst Rishi Jaluria, he's been on this stock, and he did not get excited about that initial 35% surge we saw in September. He's holding on to a neutral rating. He says his concern is that OpenAI's ability to fund the 5-year partnership with Oracle, and given the other commitments it has, specifically with Azure, which was just announced last week, that $250 billion deal. So that seems to be where the conversation is right now. Financing, how much more debt Oracle needs to take on. December is when we get the next earnings report from Oracle. Key question will be around margins for Oracle Cloud Infrastructure, which initially they said 30 to 40% at their analyst day.
Right, Seema raises the perfect point. How much more? How much more? The levels that I read to you here, they're not like fall out of the chair alarming, but the question is, these companies are tapping the debt market rather extensively now to fund some of their ambitions. How much more? You own Oracle.
Yeah. Look, I mean, this is a point I actually completely agree with what Steve said. And it's something I've been trying to say over the last week or two, which is that debt financing is good, particularly when it's collateralized by hard assets such as data centers, so that you can get a lower interest rate. Seema, I don't know where it's being quoted in terms of the when issue, but if we're talking 5 to 6%, Steve's exactly right. If you're sitting on the board, if you're in the C-suite, you do not want to issue equity to do this. And a lot of this funding is coming from capital flows, from cash flows. To the extent that they're building more than this, I would rather they use debt as opposed to giving up precious equity.
Debt financing is great until it isn't. I mean, as long as everything remains great, then there's no issue to even worry about. The chart that we put up and the spreads that we showed you, which are still super tight by historical standards, we're not bringing it up as a alarmist thing. It's what is being talked about on the street.
It's being talked about on the street, and I'm addressing it, and I think I'm being pretty clear in my opinion on it.
Seema,
which is to say there are cash flows, positive cash flows to support the debt.
Did you have another point you want to make?
In addition to the financing that Oracle has to take on, are you concerned about it using its credit quality, its investment-grade balance sheet to help developers obtain these construction loans at a favorable rate? Isn't that an additional level of risk?
Let me not make the claim that there is no risk to taking out debt, that there's no risk to what you're suggesting about financing vendors.
Data centers, yeah.
We saw what happened in the late 1990s, but they're financing vendors to build assets right now that are productive, as opposed to what we've talked about many times on the show of the dark networks. I saw them digging up the streets of Lower Manhattan in 1988, 1999, literally every week to lay down fibers. You could look at this and say, how is this really not duplicative at this point in time? We're just not at that level. Not yet.
Okay, let me answer your question. Yes, it adds an extra level of risk, but not one you should be concerned about. It's not really what equity investors are saying on this, right? Because they're not credit investors, right? It's what the credit investors, what the debt investors are saying.
Sure.
Right? That you should be, when they get worried, that's when you should get worried. But, you know, they're not worried. It's a non-event.
All right, we'll leave it there. Seema, thank you. That's Seema Modi. I think there is a little bit of a fallout, too, of what's happened in the NASDAQ this week. And it's pretty clear that you could see it maybe in crypto. There's been such a tight correlation at periods of time between the NASDAQ and Bitcoin especially. But crypto's pulled back a bunch. Let's look at Bitcoin, at least today. It was back below 100. It's above it now. But there's a pretty volatile picture of what you have. Bitcoin's down 8.5% week to date. Fourth weekly loss out of the past 5. Josh, you have a thought here. You know, there are times where they're highly correlated, NASDAQ and Bitcoin, and there are times where that has broken down, but it appears at least today to be back in play, or at least this week.
I think the most recent zeitgeist that has overtaken the crypto commentary, not Wall Street's commentary on crypto, but crypto's commentary on itself, is that some of the bull case for this asset has been based on the fact that it's been rising. And we have a lot of stocks like that too, so this is not unique to crypto. But when it stops rising, not even falling, but just kind of takes a breather for a while, the momentum crowd moves on and they look to do something else. And I think there's some element to that. We've financialized this asset. It used to be the Wild West. It's not. It's now the purview of asset flows coming into places like BlackRock, and that's perfectly fine. Doesn't mean there's not future upside, but this has become more and more TradFi as the ETF providers have gotten larger as a percentage of the daily volumes, the assets under management, et cetera. So that's sort of one thing. The other thing, I don't agree with everything Cathie Wood says, but I did agree with her comments this week where a lot of the bull case for Bitcoin was to be able to have this thing that people could transact in that's not the US dollar and not part of the traditional banking system. The problem is that stablecoins have become way too successful in order to believe that Bitcoin will be the only way. And so now maybe there's some competition if you wanted to actually use crypto to move money around. Now you have a way to do it minus all the volatility that has become more accepted by the largest financial institutions. So I thought that was an interesting comment that she made. She's still bullish on Bitcoin, but there will be increased transactions happening at places like Circle. And I think it's worth paying attention to.
Weiss, is this just a risk barometer at the moment?
I believe it is. So, you know, I cut my IBIT position significantly because it's a risk-off market, it's a bit of risk-off trade, and I still don't believe in Bitcoin. I still haven't seen, you know, basically a use case that's valid, and it's still, you know, there's no way to assess the tangible value on it. You know, gold, there's tangible value. It's a lot lower than where gold is trading, but you sort of get that, and it's been trading that way for gold's been trading for thousands of years. Bitcoin, again, you've had all its time, and you still
At what point do you decide, though, because if you are a pure momentum player in Bitcoin.
Correct.
You've laid it out. There's undeniable.
Correct. Yep.
So at what point do you say the momentum's gone, I'm done?
So here's
because you're probably not the only momentum player out there.
Right. So here's what keeps me in it, okay? And some people may not like this, but I'll tell it like it is. Trump's family allegedly has $7 billion in Bitcoin. It's probably lower over this week, like it's low with me. Trump just freed or just pardoned the head of, you know, the most influential person. And I'm following corruption. And corruption will win to a certain point, and his stake in getting Bitcoin higher is very evident. So I'm following that trail, pure and simple.
Your perspective and your point of view.
Exactly.
Alone.
Not speaking for anybody else.
Alone.
Yep.
All right, we are going to take a quick break. What a week, too, for airlines, right? Airlines surged earlier in the week following the election results, thinking that, well, okay, maybe this is going to somehow end the government shutdown. If you look at the, let's look at a week to date, not that. There you go, right? Look at that, the Wednesday move after the elections, and then here we are talking about the cancellations.
Choppy, choppy, choppy. I mean, the news all year has created a very choppy environment, whether it's the most recent on curtailing flights or Liberation Day. Ultimately, what happens as an airline investor is you look at this and you say, at first, this is bad across the board, but what happens when you reduce supply, you increase price? I'm not saying that the airlines are going to recover everything from the lost flights, but they're going to recover a lot of it with price, and that's going to stink for consumers. It's going to raise a fuss. And if we think that this is going to go on until Thanksgiving, I mean, both parties better realize that is a failing strategy and get this shut down.
Well, they may be cutting the flights that aren't profitable. So that'll further increase their profitability.
That's a good
and
point.
The algos that they have. Look, I've flown a lot recently. Every seat is full on every plane. And that's what they'll do.
Here's the thing, Steve. I mean, you're right, but the DOT is going to tell them where they've got to cut flights. Is it going to be cutting flights from? If I say Indianapolis, it's only because I've got to go there next week. Are they going to cut from Indianapolis, or are they going to cut from Newark? I think they're probably going to cut from Newark.
Well,
and
it
it's going to
depends.
hurt.
They've said that so-called hub to hub may not be impacted nearly as bad. In other words, you fly from Denver to Newark, you fly from Houston to Newark, you fly from Chicago to Dallas, American to American, United to United, et cetera, et cetera.
If I could tie it up in a bow, when the shutdown ends, that's a tailwind. This is the point. A headwind becomes a tailwind when the shutdown ends. Well, I don't know when that is.
You've had a tumultuous show thus far, probably due to the supersized Red Bull you had before we began. So I'm afraid almost to give you the catnip of Wynn. Do you want Wynn's green for the week?
Wynn's had a good year.
Wynn had good earnings. Do you want to give me a little something on that?
I mean,
you're feeling good about yourself?
I just feel calm. Notwithstanding the Red Bull. Okay, look, Wynn. Folks, if you saw Scott's face, you'd understand why I'm laughing. On Wynn, people look at the earnings per share and say, wasn't that a miss? People don't measure Wynn or the casinos on earnings per share. They do it on EBITDA, and EBITDA was a resounding beat, and it continues a string of resounding beats. Wynn is the premier casino operator, particularly in Las Vegas. That's why, despite all the talks of a slowdown over the summer, they kind of killed it in Las Vegas. And when we look out over the next year, Al Marjan, which is their UAE resort, is going to come online in early 2027. That's starting to get priced into the stock. I do like the stock.
All right, welcome back. Josh Brown's best stocks in the market. We shine the spotlight today on two more names, which are Josh Brown.
Okay, now for something completely different. When the AI trade falters, these are the types of stocks that attract buyers. I want to talk about Welltower, and I want to talk about Ventas. WELL is Welltower. Look, this is a gigantic business, enterprise value over $80 billion. They have 2,000 communities of both independent and assisted living facilities for seniors. We have one of the fastest growing cohorts in this country is the 80-year-old and plus. These people are living longer, and thanks to gains in the stock market and real estate, many of them have more money than ever. And Welltower has been incredibly well positioned. The business has been around for 50 years. They've been building up to this. They knew it was coming, and now they're ready, and they are making an absolute fortune. This is on the best stocks in the market list all year, Judge. The stock has just continued to trade higher. I don't even have a stop loss in my write-up on the risk management piece. What I would basically say is buy it, add to it slowly, but I think this name could continue to lead in the healthcare REIT space. The other one, Ventas, smaller business, same CEO since 1999. She has created an incredible amount of shareholder value. Basically, this is a situation where you've got a stock that's not quite overbought, a little bit overbought, but I would do the same thing. I would look for red days and start to accumulate slowly. Neither one of these is a yield play. Both of them are among the lowest yielding dividend names in the REIT space. These are growth companies, and there's growth as far as the eye can see for senior housing, and I think that'll continue for years to come.
How many names do you have in total now on the list?
Falling, but still north of 50.
North of 50. And how often are you going through the list looking to cull names or add?
It's all the time. It's algorithmically driven. And look, Robinhood is on the list, right? Robinhood will remain on the list. It's very high above its long-term moving averages. But this name is pulled back. Like, that's where the opportunities are on the best stocks in the market list, not pulling the trigger at an all-time high and hoping for another one the next day. We've got names that Robinhood is trading 53 times forward earnings. Value investors are not here. Growth investors are here. It's the second best performing stock in the entire U.S. S&P 500 opportunity set. It's up 232% this year. The fact that it sells off 10, 11% off its high after reporting earnings, I think if you're an intelligent investor, you say, okay, I missed this one the whole way up. Now might be my chance if I want to play a business that's growing revenue 100-something% year over year, because I think they can continue. So that's how we think about the list. And there are so many names like that that are still on our radar.
All right, good stuff. Welcome back. It's been a pretty nasty week for restaurant stocks. Just to give you an idea of why I say that, Cava's down 11%, Shake Shack's down 4.5%, Brinker's down 5%, Chipotle is down 4%, Sweet Green was down big in the pre-market. It was down 20%. It's paired that a bit, but it has not been great. Wendy's had earnings today. The stock was up, the comps were down, but they were less than expected. They were down less than expected. What, Josh, is going on here? Is this simply concern about consumer spending? You've seen that show up in some of the results. You've seen it also show up, frankly, in a lot of the commentary from some of the CEOs.
Yeah, there's really no such thing as, quote, the consumer. We have all different tiers of consumers, and every time I want to get negative on the consumer, and it's tempting to do because I listen to people talk, then I get the Bank of America credit and debit card spending, and it actually said that consumer spending is, their word, not mine, accelerating. So I know that this is a convenient scapegoat, and companies will come on and they'll say, well, at the lower end, the consumer is struggling, as if there's ever a time where at the lower end, the consumer is like doing just peachy. So I think there's companies that are operating and executing, companies that aren't. In the case of Shack, they absolutely crushed their numbers. They beat by 1% on revenue, but they beat by 17% on earnings per share, 36 versus 31 cents. And margins were better than expected, 14.7%, which was an almost 5% beat. So Shack is executing 630 stores at quarter end. They are doing much better on the labor side as far as retention, keeping people for longer and not having as much turnover, and new equipment, new marketing campaigns. So as a shareholder, I'm good. Like, I didn't hear anything that would make me change my mind.
Closing bell this afternoon, 2 hours from now, Jeremy Siegel of the Wharton School will join me, along with Chris Toomey, Rick Heitzman, Warren Pies, and Bryn Talkington, and I hope you will as well, because we got a lot to talk about as we look into a new week. Josh Brown, final trade from you, please.
Joby Aviation is in a pullback, spoke to the company this week, headed to the Dubai Air Show, and they are super excited about what they're going to be unveiling. So I am too. Who knows what it could be.
All right, the low-altitude economy remains a favored play. That stock today down almost 6%. Kevin Simpson, Mr. Three-Piece. Mr. Three-Piece.
Marathon Petroleum. This stock has a lot to like. Record free cash flow, increasing dividends, and record share buybacks.
Jimmy Red Bull.
ExxonMobil.
You feeling good?
I am feeling good. ExxonMobil, also an energy source. This is a stock that has done very well despite the fact that crude oil is down 20% this year to date. And if you look at the recent momentum, I think it's going to continue.
I don't advise you to drink that, though. I would stay with your Red Bull.
Advice taken.
Well, we're going to offer him different advice.
What about you, Weiss?
Meta. Look, this is a permanent compounder, a term I often use, and I like it right here.
All right, good stuff. Good weekend, everybody. I'll see you on the bell. All right, welcome to Closing Bell. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange. This make or break hour begins with a very tough week for tech. Whether that trade has more downside to go, we will ask our experts over the final stretch. But we do have a turning market picture as we enter the final 60 here on Wall Street for the week. There it is. That's not how it looked for much of the day today. So the Dow has gone green. S&P still negative, as you see, as is the NASDAQ. But the NASDAQ was down about 1% early on. It was going for a streak that it didn't want to get either. It was in danger of posting its third 1% decline in the past 6 times, the past 6 sessions. So we're going to watch all of that. And the market is moving on maybe an olive branch in the government shutdown down in Washington, D.C. We're going to have the very latest on that in just a moment. We're following Tesla, of course, the aftermath of that vote. The $1 trillion pay package for Elon Musk, it passes. The stock, nonetheless, is still down. Banks are mostly red. They have been for much of the day, but what I say now may be irrelevant because of the headline that I was talking about. JP Morgan is now green. Banks are off the worst levels. We'll show you the airlines, too, relative to the news of the day. Hundreds of flight cancellations. By now, you know that story well. A fallout from the government shutdown, and the airlines are actually green. Let's just bring in Emily Wilkins now to give us the breaking news on what we're learning out of the nation's capital as this stalemate has continued. Emily, what do we know?
Scott, we just saw a brand new offer on the floor from Chuck Schumer and Senate Democrats, basically telling Republicans that they will vote with them to reopen the government as long as Republicans can agree with them to provide a 1-year extension of those Affordable Care Act tax credits that have been keeping premiums low. Democrats are also asking that there's a bipartisan group that'll work together, figure out some of the reforms that Republicans have said they wanted to see on those tax credits. Important to note here, Senate Republicans have actually shown a lot of openness to finding some way to extend these tax credits. They do want some caveats, some limits on them, but they do overall seem to be supportive of making sure that those tax credits are in place to keep healthcare costs and premiums low. Of course, the question is, what can you expect over in the House? You have seen a couple of moderate Republicans, though, who have made this similar pitch, give a 1-year extension and time for them to work out something. So now the ball's going to be in Senate Republicans' court. This all just happened, so we're going to be watching to see if Republicans think this is an offer that they can take. If it is, there could be a way to actually end the shutdown, maybe today, maybe a little bit later this weekend, but we're going to have to see what the counter proposal is now that Democrats have come out with this brand new ask, but certainly a major shift from the stalemate that we've been stuck in for weeks and weeks now. Scott?
Yeah, leading to that shift in the market that I was just talking about. Emily, thanks. Keep us up to date. Any response from the Republicans, we'll put you right back on as we continue to follow that development. Just to touch on the market, the Dow is still green on the headline that Emily Wilkins was bringing us just a few moments ago, this offer from the Democrats to end the shutdown, and we're waiting on a response to that from the Republicans. You can see mixed market picture right now. Let's bring in Jeremy Siegel. He is of the Wharton School, of course, the professor of finance, Wisdom Tree chief economist. Good to see you. Welcome back.
Good to be here, Scott.
We'll get to the story of the week, which is obviously a little anxiety over AI, if you will. But the news that we just got, not related to stablecoins per se, but from Emily Wilkins about a potential breakthrough, or at least an offer to try and end this government shutdown. What do you think it means to stocks?
Well, I mean, I about 20 minutes ago, I saw the Dow go up 150 points in about 30 seconds, and I said, something's afoot here. I didn't know at that time, and I was thinking it could be an offer. That's why it's so dangerous to be short in this market, because, you're going to get a pop if it reopens. Very honestly, I think the Republicans would be very smart to take this offer. I don't think the government shutdown has worked to their advantage at all. Certainly in all the polls that have been taken, it hasn't worked to their advantage, even though they're the ones that have voted to keep it open. The public thinks, hey, the Republicans control Congress, they control the presidency. I'm going to put the responsibility on you. This is a way off. It's a lot less money than the $1.5 trillion that was bruited, by Schumer early on. We wanted this and this and this, as has been said, a lot of Republican districts, are not really prepared for some of these increases because, I mean, the tax break is probably only 15 to 20%, but healthcare premiums are going up so much that anything that can help moderate those, especially for the lower income groups, which are a lot of Trump supporters, as we know, I think the Republicans would be wise to take it. I think they will.
Professor, I appreciate you reacting so quickly to the news of this moment as we see it obviously impacting how this market is trading with less than an hour to go in the week. I want to steer you, though, to what I think has really been the story of this week, and that is anxiety over this AI trade. I'm wondering what you make of it. The fact the NASDAQ has certainly come off its worst levels, but it's still down more than 3% on the week. And many of these big AI-related stocks have obviously been extraordinarily volatile this week. What do you make of it?
Well, 2 weeks ago, for those 2 weeks, they shot up. And relative to the market, I often chart the tech stocks relative to the market. It was sort of shooting up and shooting back down. And now it's right back at the trend line. And the trend line is still that these stocks over the last 6 months, over the last year, after 2 years, are still moving up relative to the next, to the rest of the market. That trend certainly can't continue forever. What I think, though, Scott, whenever anyone says it's the beginning of the end, and when everyone starts saying it's the beginning of the end, I begin to say, hey, no, that's not the way it works. Well, it's usually when everyone is totally optimistic that you see the market begin to crumble. So I still think the AI trade is on. I mean, I hear the arguments against it. Meta is having particular problems because of all its, capital expenditures. And, it is true because I've done the research for firms that do too much capital spending actually have underperformed over decades in the market. And we'll put Meta in that category. But the rest of them are generating those profits with that expenditures. I'm interested to see how the market does if the Republicans take this and it reopens. I think then once that cloud is out of the way, I think we're going to get a truer look. Then we're basing stock prices on the state of the economy. I think this shutdown could shave 1.5, maybe 2 points off of GDP this quarter. Certainly, if it goes on and they don't take this offer. We saw consumer sentiment. Anything, it could be 3. I would say that it has to end the week before Thanksgiving, because that's usually the earliest that everyone travels to their family.
Sure.
No one wants that to happen. But I think that, as I say, I think the Republicans will be wise to take it, and I think you'll get a bounce. But then look, next week, if we get a settlement over the weekend. I want to see, now we got to look at the effect of, what's going to, happening on the slowdown, the layoffs, whether the tariffs are going to affect the Christmas buying. When people see the prices, complaining about those high prices, I think we're going to shake out what the real economy looks like.
Well, I mean, on that note, were you at all alarmed by some of the information this week related to layoffs, job losses, Challenger? That information raised a lot of eyebrows. Rick Reeder, said to be in the final 5, in quotes, of the next potential Fed chairs, is suggesting in an interview that the labor market is softening to the point interest rates should be lowered down to 3%. The layoff announcements that we've gotten have been quite substantial, the highest in some time. Are you worried?
Well, yeah. I mean, the Challenger announcements was a shock. Now, that was October. What is puzzling, I think, Scott, is why are weekly jobless claims holding up? They're not showing deterioration. It was a mild increase, but still well within the range. I know they're put together, not from the federal government, but we still have a very, very accurate number. I want to see whether that deteriorates or not. But probably more important than that is if we do see that deterioration, then no matter what Goolsbee and everyone's saying about inflation, the December rate cut is a slam dunk.
Oh, wow.
I mean, I think the Fed basically is going to have the back of the economy there. They're just waiting to see the actual data news that confirms, if it confirms that will happen. That will be something I think that supports the market. Listen, I've been on this show for a long time. I think the Fed funds rate should be in the mid 3s. Given the 10-year, I mean, you might want to go down to 3.0. But I think that would be a normal term structure of the interest rate. 409 for the 10-year, 350, 340 for the Fed funds. That brings back normality to the curve.
Oh, interesting. Opposite Capital's Bryn Talkington now, and JP Morgan's Stephanie Aliaga. Bryn's a CNBC contributor. Of course, the professor is still with us as well. Bryn, do you care about these ever-growing numbers of debt being raised to spend on the AI build-out?
I think you have to be mindful of them. Obviously, we talk about private credit. This is going to be into the public market that we all get to enjoy all of this debt issuance. As a company, it's smart to do that. I think where companies specific like an Oracle is now, I believe, negative free cash flow. So Oracle, even though they have a $670+ billion market cap, they're going negative free cash flow to fund this. And so I question Meta. The next 2 years is going to have 40% of capex to revenue on this build out. And so I think you really want to start looking company specific, because Apple's only at 5% capex to revenue. Microsoft and Google and Amazon are still much lower. And so I think a small amount of bond offerings makes good sense from a company perspective. But clearly, I feel like Oracle is the poster child, because it's almost close to giving up that full gain that it got the day it did that big announcement with Sam and them. So
it pretty much did. I'll come back to this in a minute, but I do want to get back down to Washington and Emily Wilkins, as we're hearing now from the White House. Emily.
Hey, Scott. So, yeah, hearing from a couple different folks here. Number one, I am hearing from a couple of Republican aides that this offer now made by the Democrats, that they will vote to reopen the government if Republicans provide a 1-year extension of those Affordable Care Act tax credits, is not going to be accepted by Republicans. I was told that this offer was actually made several weeks ago, that it was rejected by Republicans. We're also now seeing a statement come out from the White House on this, a White House official saying that Democrats are making clear they're holding the American people hostage for other spending. This is a huge climb down from their initial position, shows they're under massive pressure. They go on to say that Democrats should reopen the government today, and the administration then will meet with them on the tax credit and work on it. So going back, really, Republicans sticking with their initial position that they are open to talking about these health care tax credits, but only after Democrats provide the votes to reopen the government. So if this kind of continues, this breakthrough might not be much of one at all, and we might be kind of back to where we were, where both sides are really dug in firm. And remember, for Democrats in particular, I do know that there are some more moderate Democrats out there. They want to find a way forward. They want to reopen the government, but they are getting pressure from maybe more centrist or more progressive Democrats who are saying, look, we just got big wins on Tuesday. The American people are telling us that they want us to hold out and really fight for health care, and we need to do that. So I think undetermined yet exactly if there's going to be a vote today, what that vote is going to be on, and how much longer this shutdown is going to go. Scott?
All right, Emily, thank you for the latest. Emily Wilkins, so much for that, Professor, apparently.
Well, it's interesting. The market hasn't gone down maybe a couple ticks anywhere near as much as it went up when this offer was given. So maybe this is just a Trump GOP bargaining position. No, we don't like this, but as an opening, I think that it still could be one.
Stephanie,
I don't think it's slammed shut at this point. I think they may give a little bit more on each side, but remember, Trump's strategy is always take an extreme and go in and bargain down from there. So yeah, we're going to reject this, but behind the scenes, maybe there is talk. Again, listen, I'm not a congressman. If I were the GOP, I would be doing that. But
okay.
I'm not in the government.
Hello, everybody. Welcome to Blue Cloud Trading. I'm George. It's Friday. It's November 7th. Hope you're all having a good day today. It's 5:15 p.m. The market's closed. We're going to look at the indices. Look at this rebound here since 12 p.m. Nice. It happened in all the indices. Dow was up 0.16%. The NASDAQ still down 0.21%, but it did recover quite a bit after that big drop. And same thing with the Russell 2000. up 0.52, and the S&P 500 up 0.13. So, who could have expected that, right? But the shutdown situation it looks like there's some, some signs that there's some progress, finally. Wall Street ends mixed on signs of shutdown progress. The Democrats proposed a deal to end the shutdown. The question is, will the Republicans accept it? I don't know. We'll find out over the weekend, I guess. What else? Expedia jumped after annual revenue growth forecasts. Okay. Let's take a look. Now, by the way, here's the other thing we're going to do in this video. We're going to cover a number of stocks that were talked about on today's halftime report and closing bell. You guys saw Josh Brown. We saw Jeremy Siegel. And there were about 13 ETFs and stocks that we're going to cover from the shows. I'm also going to cover the SPY, the S&P 500, the NASDAQ, the the Dow Jones, the Russell 2000, Euro stocks, VIX. In this video, we're also going to take a look at some of the Mag 7s like Tesla, Apple, Meta, Microsoft, and the strongest sector. Okay. And that's it for today. So let's get into it. Okay, let's start off first by looking at the maps. We got to look at the heat map. That's important. Let's get back to the heat map here and see how the individual stocks within the S&P 500 did. Okay, Tesla was down 3.68%, Google down 1.98%, Broadcom down 1.73%, Oracle down 1.86%, but a lot of stocks like Amazon was up, Meta, you can see here, Palantir was up 1.65%. Yeah, so, we had the real estate and utilities and basic materials and energy all in the green right there. Consumer defenses did really, really well. A lot of the financial stocks here started to do pretty well as well. And let's look at the after hours, because there's a little box here that I'm going to select. I want to look at the after hours performance and see how these, like the ones that are in the red, are doing. And you can see even Google, Meta, Tesla, Amazon, Nvidia, they're all moving up after hours. So that's a good sign for Monday. Let's take a look at the 1 week performance. Not so great, right? This was not the best week, but we did end on a positive note, and maybe that will move into next week. We'll find out. If we want to look to see what sectors did well today, we can look at the 1 day performance here, and you can see energy was up quite a bit, up 1.52%, followed by real estate, utilities, basic materials, and consumer defensives. All right. And then communication services and technology were down today. So let's get into the stocks now. We're going to start off with the S&P 500, the SPY ETF, and then we'll get into the rest of these other ones. We are using the Ichimoku indicator. And there will be a tutorial. If you haven't seen the tutorial yet, it will be at the end of the video. There'll be about a 4 to 5 minute video, and you can learn a little bit about this indicator that I'm using. It's not as complicated as it looks. I know there's a lot of lines here, and it might be a little bit overwhelming the first time that you look at this, but it's really simple, and it's all based on math. It's an interesting indicator because of the basically the longevity, really. I think that's an interesting factor. And it was also developed in Japan. It was incepted in the 1930s and then brought to us here in the 80s, published in the late 1960s in books. And a lot of financial institutions use it to help them basically assess the market, assess a stock or ETF. You can use this for Forex. You can use it for pretty much any instrument that you want to trade. So the S&P 500, what's happened, you can see very clearly here. And let's not forget the Japanese here also gave us the Japanese candlesticks that help us to identify what transpired. If you're looking at a daily chart, for example, we can see that today, for example, there was a hammer, a bullish hammer that was developed. That's very important. What it's telling us is there's a higher probability that on Monday the market will move up, even though technically we are still under these two moving averages. All right, so this is a good sign. This is a weekly chart. Okay, another positive note. Remember I said yesterday, as long as we remain above the Tenkan-sen, the 9 period, I think we'll be in good shape. And I also said that we need, even though price was under the Tenkan-sen yesterday, we needed to wait until Friday around closing time. And as you can see, it held up, just like it held up there and there and there, and then bounced. So I'm getting really optimistic about next week. I think that something is going to, the shutdown here is, there's so much pressure that are on these politicians. They're going to feel it very quickly, especially if the airlines and everything else continue to all these people that are relying on their salaries, for their in the airports and everything. Everybody wants to fly out, see family for Thanksgiving. Can you imagine the backlash if they don't get the shutdown, basically end the shutdown, and people can't go and see their families? Oh man, it would be a nightmare for them. Getting a little out of hand is what's happening in our government, but that's for another day. The SPY ETF looks good. That's all I'll say. I'm liking it. Yes, it's, like I said, it's pulled back, but now here's an opportunity. If price breaks above the Tenkan once again, that will give us another opportunity to get back in. The directional movement index does look negative still because of this pullback. All right, so I'm not suggesting that this is today was the day to jump in, but again, if we see some strength going into early next week, I think that will be a nice catalyst, especially if the shutdown does actually end. Here's the QQQ ETF, another bullish candle, another bullish hammer. Okay, same situation here on the daily chart. Here it is in the weekly, also stalling at that 9 period. Whoops, I was going for that arrow there. As you can see, the 9 period is that green line. It takes the midpoint of the last 9 periods and plots it right there, and that's the 26 period, the midpoint of the 26 periods, and we're still above the cloud. Okay, and so that's good for the weekly chart. The Chico span is above price. The future cloud itself is very bullish still, so that's what we have. Here's the Dow Jones, up 0.12% today. Similar situation, as you can see that price did during the day. It pierced that moving average, but then the buyer stepped in and pushed it up. Now, how do we, why do I say this is bullish, and why do I say the S&P 500 is bullish in the Qs? That lower wick is really important. It represents, we're looking at a weekly chart. That represents today's candle, is that wick that you see. And then this longer wick on the daily chart also represents a lot of buying that happened once price reached this low. And we can see that if we switch it to a 5-minute chart. Okay, so here's the 5-minute. So you can see that here we were gapping down in the morning. We had that big drop, right? And then price broke above the Tenkan. That was the first signal that started getting bullish. It held under that Kijun-sen for a little bit. Isn't that interesting how the Kijun-sen held it in place for a little bit? But then once it broke, boom, it moved. It continued moving up. And from that point, the Qs actually moved up about almost 1.5%. Now that's a 5-minute chart that we're looking at, okay? And the same thing happened here in the Dow, all right, the SPY, and even the Russell 2000. In fact, the Russell 2000 looked even more strong because it broke above on the 5-minute above that 200-day. It's a 200-day 5-minute chart. So, yeah, I'm liking what I'm seeing now. The Russell 2000, unlike the other indices here, it probably looks the weakest out of the bunch still, only because of the fact, if you look at the daily chart here, we have a negative crossover that took place, and yes, we actually opened up inside the cloud, but then the buyer stepped in, like I said, and pushed it right above. So they worked hard to get price above the cloud, and you can see that in the volume. But we are still dropping, and so if the news, end up negative going into next week, it's all based on the news, right? That's what's going to help push the price up. If they end up negative, then we can see the price drop, of course, certainly. Now, the VIX is sort of a representation of the fear and volatility that's in the market. And so even though, so with this here, you can see it actually jumped quite a bit, right? It actually moved from this level here. It moved up, let's see, about 20%. Okay. So it moved up, and I'm sorry, from this level, the opening price, it moved up, let's see, 16.4% or so. Okay, it's around that, 16.4. And then it finally dropped. And here's a 5-minute chart on the VIX. So you can see that big gap up, the move up, and then right around that time, 12:20 p.m. or so, price got under the Tenkan and it dropped quite a bit. 13.8%, 2%. That's a big drop on the 5-minute chart. So I like what I'm seeing with the VIX. And that shooting star is a negative, right? We want the volatility to drop. When this is moving down, the market's typically moving up, as you can see, right? FEZ is the Euro Stocks ETF. This one is still, obviously it's staying under the moving averages, but it found support right at the cloud and bounced off that level. It was up 0.37%. And of course, if you look at this on the weekly chart, also holding up above Tengen and Kijun. So even in Europe, the stocks there are looking pretty strong still. They're holding up. All right, let's look at the stocks they talked about on the show. And here's one of them, which actually happens to be a stock that's in my portfolio. It's one that I added on October 27th, and I'm still holding on to it. It's up over 6%. It's just, one of the stocks they talked about. I'm still holding on to it. If this candle here stayed under the 189.53 level, I probably would have taken my profits, but because it closed above and was looking really bullish still, even going throughout the day, I held on to this position. I think it's going to probably continue moving up. Real estate sector was strong today, right? It looks good on the weekly chart too. It's a nice chart. VTR is another one. Ventas, okay, that's also a real estate sector REIT in the healthcare facilities. This is another one that I'm also holding on to. I added this one back here on this date on October 30th, and it's up over 6%. Now it's coming close to a 76.57 level, which is a monthly level. And by the way, I go over my entire portfolio in tomorrow's members only video. I mean, we're talking about many stocks that I hold. I also talk about the stocks that I closed out of throughout the week. Consider becoming a member, guys. Really easy to do it. While we're here, might as well share with you how to do it. Just click that join button. Go to my Blue Cloud Trading page. You can subscribe for free. You can hit that notification bell so that when my videos pop up, you'll find them easily. But then if you want to go one step further and get access to the member-only videos that I do every weekend where I go over my entire portfolio, it's very educational. Hit the join button. Okay, hit that join button, and you would have to either become, a Blue Cloud Trader level member, this mid-tier level, or the Blue Cloud Legend level member. The difference between the two is under this level, you get those videos, but you also get access to some of the day trading videos I've made, as well as the daily trade updates each day, Monday through Friday. Before the market closes, I share what stocks I'm closing out of, what stocks I'm adding to the portfolio. And so there were trades today. You can find those once you become a member. There'll be a new tab that pops up next to posts. It will say membership. You click there, that's where you'll find them. All right, let's get back. So here we are with VTR. So I like VTR. MPC, Marathon Petroleum, Kevin Simpson's final trade. I like this one too. Here's the weekly chart for you. You can see we've got a future bullish cloud on the weekly chart. Price is above the moving averages. Chico span is above price. Everything looks good on the weekly. It wasn't looking so good in the beginning, right? In the first part of the day, you can see that long wick. Here's a 5-minute. I'm sorry, that's a weekly chart we're looking at. This was the daily. This is that big drop. It got under the cloud and then bounced and moved right back up. So yeah, once price starts dropping and you go into management stage. All right, you got to start managing that trade and monitor it day after day and see how it if it looks like it's recovering. If you start seeing some strength, if you start seeing bullish candles, that's a good sign. Okay, you got to allow that the price to move back up if it's giving you some insights that there's a probability. It's an evidence-based approach that we're going for here. You look at this one and you can see that there's some lows right here. Okay, notice how price stayed closed above these lows. Did not break. Yes, it closed. It basically broke and pierced it, got under that cloud, but then it recovered. And now we've got ourselves a reversal candle on the daily chart once it reached these levels, which is kind of funny. But again, overall looks pretty good. XOM is another stock they talked about. That was Farmer Jim's final trade today, November 7th, ExxonMobil. And I like this one because if you look at the weekly chart, The cloud itself has just started getting bullish here. I mean, overall, the cloud itself is flat. Okay, so it's not like an ultra bullish pattern situation here. I think it's a wait and see approach because right now there's a pattern that's forming. It's called an ascending triangle based on this trend line here and this flat line right here that builds this triangle. It's called an ascending triangle pattern. And if price breaks above that level, okay, which is around 118.50 or so, $118.50, I think that there's a higher probability that this thing will take off. I like the fact that the ADX is moving up. That represents momentum. Okay, that's good. And the green line is above the red line. Now the rest of these do not get a blue flag, and they're not something I would recommend at this particular time. As far as adding, if you have a position in any of these stocks, you can certainly wait it out and see how it does. Okay, you can certainly manage that trade. But let's look at IBIT, Bitcoin. Here's a perfect example. I mean, this one has pulled back. This is a weekly chart. Okay, holding up above that weekly level of 56.63. Yes, it's under the moving averages, but it did find support right there. And if you look at the daily chart, look at these 4 days, right, where price has been stagnant. And so, yes, it's still under the 200-day, that dotted yellow line right there, but it's also holding up above the 56.62 level. So uncertain what's going to happen here with this one, but would I be adding positions? No, I wouldn't be adding any new positions, but I would be certainly managing it if you happen to have a position in this. WYNN, Wynn Resorts. Farmer Jim was talking about this one. The future cloud has turned a little bearish here. Senko Span A crossed into Senko Span B. Prices inside the cloud. I'd skip this one for now. Robinhood popped above the cloud today, up 2.58%, but it still is under these moving averages, the green line and the red line, the 9 period and 26. So I'd hold off on Robinhood. SG is sweet green. And I mean, this one has had a big drop. Let's look at the weekly chart on this. The highs go all the way back to November 29th, okay, 2024. The price was around $45.53. It's dropped 87.27%. What's interesting and ironic is I've walked by these stores, the sweet green stores. There's no one ever in these stores. I never see people just sitting in there. I mean, it's very rare. You'll see maybe 1 table or 2 tables. It's just not an in-demand sort of restaurant, and it's not doing so well. And it's evident here in the stock price. Okay, let's take a look at the next one. This is Shake Shack, Josh Brown's final trade back on February 19th and July 31st. And let's see. Well, it's been under the cloud for a little bit here on the weekly chart. You can see it broke under back on August 8th of 2025. And since that point, it's down about 14%. Right now, it looks like it tried to recover this week and break into the cloud, but it was unsuccessful, right? It stalled right there. It actually, you could see what happened. It actually opened up slightly higher and then dropped, creating a bearish engulfing pattern. That's not good. That's a weekly chart. Here's a daily chart. So it's still looking pretty weak, down 0.87%. And you'll notice that the ADX is still moving up. So I would stay out of this one. It's not the right time for it. Joby, this was Josh Brown's final trade today. So November 7th. He also recommended it back on July 10th. It's under the cloud. Senko Span A is under Senko Span B. We've got a bullish candle today. It was up 4.05%, but this is a very volatile stock also. It's got a high beta, 3.81. The price of sales is really high. No profit margins yet in this, negative profit margins. So very speculative. And he's said that in the past as well. But right now, technically speaking, we've got ourselves a lower high here, right, on the daily chart. Another lower high, and it broke through this low here. And I would not be jumping into this at this time. UAL, United Airlines Holdings, moved up a little bit, 1.79%, but it's inside the Ichimoku cloud. No on that one too. Here's the weekly chart under the Tenkan-sen. Delta Airlines on the weekly chart under the Tenkan-sen, but above the Kijun-sen and cloud. The cloud itself has turned bullish here. This was Jim Lebenthal's final trade back on September 11th. Here's the daily chart. Still under the Kijun, so I'd hold off on that one. But American Airlines. Let's look at the weekly chart. Okay, so this one here stalling right at, notice that. How interesting is that? That it's stalling right at the flat part of the cloud. Okay, and the 200-day happens to be at the same spot. So this double resistance right there. So price keeps on stalling. If it can break above the 200, I think that you got yourself some potential here. But that's a big if. And you'd have to wait until Friday of next week because we're looking at a weekly chart here. I wouldn't speculate and try to get into this thing before price closes above the cloud and above the 200-day on the weekly chart. And by the way, I still would stay out of this one altogether for one main reason, and that's because the future cloud, the single span A here, is still under the single span B. Typically, I want to see both. I want to see this light blue colored line above the purple one. Okay, that's important, and we don't have that yet. That's the stocks right there. Let's take a look at this Mag 7s real quick. Here's Tesla, still stalling at that trend line that I've drawn. It pierced it today. Here's a daily chart. I'm sorry, that was a weekly chart. During the week, it pierced it right there on Monday, November 3rd, but then dropped, and now it's finding some support at the cloud. Maybe we'll get a bounce on Monday. We'll see. But it was down 3.68%. Here's Apple. Let's look at the weekly chart first. We got a negative spinning top, down 0.48% today. Here's the daily chart. Under the cloud, under the Tenkan-sen, the 9 period for 2 days now in a row. So I'd want to wait before jumping into this one. It needs to get back above the green line there. Here's Meta. Now today it was up 0.45%, and yes, it did build and create a bullish hammer candle. This is a bullish candle. Here's a couple, just show you guys some of the candlesticks that we have here on the cheat sheet. So if you go under bullish and you look under the single candle patterns, there's the hammer right there. Long wick, small body. If you see this candle after a pullback, right after prices dropped, that's very bullish. Whoops, wrong thing. Let me get back to that. Sorry. Oops. Here we go. So if you see, like I said, price drop, and you see that candle, there's a higher probability it's going to move up. No guarantees. All right. If you're unfamiliar with understanding candles, take a look at this real quick. Opening price, closing price on a green candle. The wick represents the high of the day, the low of the day. If you're looking at a daily chart, red candle, opening prices at the body, top of the body, and the closing price at 4 p.m. during the day when the market closes is this part. The wick represents how low the price dropped throughout the day. The wick in the top represents how high the price moved up throughout that day. So it's giving us so much information. You know, the opening price, the closing price, and the color determines where the opening price was versus the closing price. Okay. And we've got all these patterns right here. And by the way, if you like this particular candle pattern reference sheet, you can get it for free on my Twitter page, x.com. Let me show you that real quick, how you can get it. Just come to here, type in, find me in the search bar under @BlueCloudTrader. Okay, @BlueCloudTrader is my handle. And then click on, scroll down, and next to post, you'll see replies, and click on highlights, this part right here. Scroll down a little bit, and there it is. And you'll also find this also, the stock patterns cheat sheet, like the ascending triangle that I was just talking about right there. Okay, let's get back. So where were we? We were talking about Meta. It's under the cloud. I would stay out of this one for sure. It's broken through multiple, support levels here on the daily chart. You can see that low was taken out. We have a lower high here than this high. And if you look at the weekly chart on Meta, okay, there's a possibility that we might see a bounce because it reached the bottom of the cloud here. Okay, so there's a good chance that we might see it. This might be the end of the pullback, but I'd want to see further evidence, and I'm not going to take a chance in adding a position until I see all the other elements of the Ichimoku start showing some strength. Here's Microsoft. Today, it actually closed under the Kijun, and it looks like it did. So Microsoft dropped and closed under on the weekly chart. That's a weekly candle under the Kijinsen. That's a big deal. Now, it didn't happen on high volume as much as the prior week. Okay, we had lower volume here. And on the daily chart, we've got a reversal candle here. We have a doji. So again, if you see a candle like this after a pullback, a drop in price, you know, Monday could be the day that things turn around. Why is this a reversal candle? Take a look at the body. It's almost non-existent. It's just a line. It looks like a little cross. Why is that? Because the opening price and the closing price basically are on the same level. Okay, so now let's take a look at the final segment here. Just real quick, yes, you can see a lot of the sectors and ETFs moved up here. They were all a lot of bullishness today. But technically speaking, pretty much all the ETFs here, there's something off related to their technicals on the daily or the weekly chart, except for one, and that's XLV, the healthcare ETF. So XLV, here it is on the daily chart. Price is above the Tenkan-sen. Price is above the Kijinsen. Price is above the cloud. The future cloud here, Senkou Span A, is above the Senkou Span B. Price is above the 200-day. Right? And then finally, one last element here, the Chikou Span, which is today's closing price, projected 26 periods ago. Whoops. Yeah, the white line right there. Okay, that white line is above the candle 26 periods ago, so that's bullish. And so XLV I like on the daily, and here it is in the weekly chart as well, holding up above the cloud still. All right, now the Senkou Span A and Senkou Span B, they're just about to merge right there. That's the one thing that's kind of missing a little bit, but I think it's going to happen for healthcare. It is a defensive stock after all, or I'm sorry, defensive sector. And the other thing I like about it is the ADX is still moving up on the weekly chart, so I do like that on higher volume. I would have liked to see the green line moving up as well, but the red line is moving down, so that's good. The rest of these I'm not going to get into, but I will be doing some sector analysis this weekend in the members only video. If you want to check that out, consider becoming a member. Again, how do you do that? You basically just go to my homepage here, Blue Cloud Trading, click the join button, select Blue Cloud Trader or Blue Cloud Legend. I recommend Legend if you want to get the daily trade updates. And stay tuned for that tutorial, okay, of Ichimoku. And guys, hope you all have a great weekend. I will catch you all in the next video. If you look at the weekly chart for the SPY, I mean, we are obviously in a very strong uptrend here. Just really quickly, let me show you what we're looking at here. This is the Ichimoku indicator. It's a Japanese indicator that was basically incepted in the 1930s, late 1930s, folks. It was published in the late 1960s and then came here to the United States sometime in the 80s, I think, is when they started adopting it. And with software, imagine trying to plot this on a piece of paper. It's based on mathematical models, but imagine trying to do that before computers. So let me just briefly tell you what these lines mean. The green line is the midpoint of the last 9 periods. It's plotted right there. Not the closing price, but the midpoint. So think of each of these candles. It takes the highs and lows of the candle and then divides it by 2, finding the midpoint of each candle. So it's giving us an average, really. And the 9 is the green line is a 9 period. So it's looking at the last 9 periods. This one looks at the last 26 periods, the midpoint, and projects it right under the candle. Okay. The white line that you see right over here on the left, that's the closing price today. All right, so that's today's closing price projected 26 periods ago in a line form. Okay, there's different ways to plot price. So in this case, what we're looking for is for the white line to be above the candle 26 periods ago. And we're looking at a weekly chart, so that's 26 weeks ago. All right, there's the candle 26 weeks ago right there on May 2nd. And so when the white line is above it, it's bullish. If the white line is under, bearish. Here are some instances, for example, where the white line was under for an extended period of time when it probably didn't make sense to be adding positions at that time, okay, in the markets. I'm sure you guys remember 2022, right? It all started right there around 2022, and then it continued through, And this thing started to emerge around mid-2023, and then the market started moving up. So what else is this indicator comprised of? It's the cloud itself, right? The Ichimoku cloud. And so that's comprised by taking the Senko span A is the upper line, and that takes the midpoint of these two moving averages. And what it does is it projects the midpoint 26 periods into the future. Very unique concept. And then the purple line is called the Senko span B. That takes the midpoint of the last 52 periods, these candles here. Instead of projecting it under the candle like it did in this case, it projects it 26 periods into the future. Cool, right? So we're looking. We've got some. We've got things that are plotting in the future. We've got things plotting in the past, all based on price. All right, and it helps to guide us. Really, think of it like that. It's a map, right? It's gonna give us some insights about what's transpiring at this particular moment on different time frames. We can look at this on a weekly chart. We can look at it on a daily chart. There's the daily chart right there. That's also bullish. What we want is price to be above the Tenkan-sen, the Kijun-sen, and the cloud. Okay. And if you're wondering what Ichimoku stands for, Ichimoku stands for at a glance. So the idea is to see quickly, visually, where are we? Okay, on this chart. Very briefly, you know, if all these elements are in play, that we have a very strong uptrend. When things start falling apart and price gets under any of the moving averages or inside the cloud, then there's weakness, and we can identify how strong, you know, the weekend trend is. Thank you for watching. Appreciate all of you guys. Don't forget to hit the like, subscribe button, and click the join button, and maybe consider sharing this video with someone. And I'll catch you all in the next video.